Hello, I'm Shaun Richards of Not a Yes Man's Economics. What I want to talk to you about today is one of the main themes happening, however the way you want to put it, at the credit crunch era, which is the way the banking sector struggled. We've seen this particularly in Europe, in the UK, but in general, there's quite a lot of this around the world. And this all started back really in the 1990s in Japan, something that's a sort of hot topic for me. I worked out there back in that stage when this all began. If we look at the two main issues of how this has come about, number one, in my opinion, is that there's been so little reform in the banking sector. The scandals have gone on, but in some ways, more importantly than that, the actual structure hasn't changed, the methodology, how they go about it. We used to see chief executives come and they go, they get well paid, but the situation doesn't really change much. This then comes to the next issue which feeds into it, which is the thing that was supposed to bail them out and give them a new start, which was lower interest rates, and then at a later date, lower bond yields via QE, so lower long-term interest rates, is now hurting them. This is a sort of awkward concept in some respects, but we saw the interest rate cuts as a way of helping bail the banks out, get the financial system, if you like, oiled again. But as we now get to low and negative interest rates, we see that the banks now really in many respects don't have a business model. How do you have it when you are supposed to live off interest income when in a broad sweep there isn't any? If we take that forwards and look at my home country, the UK, the sort of bellwether, and not in a good way here, is Royal Bank of Scotland. If we look at that, the share price today has fallen below £2. Why does that matter? Well, for example, if you're a UK taxpayer, you're invested in at a bit over £5. If you actually allow for the financing costs that have come along the way, according to the National Audit Office, they're in at £6.25. If we go back to the rhetoric of nearly 10 years ago, Lord Miners, who was involved in the bailout back then, announced this as a nice little nest egg. Well, some nest egg, because it's now about a third the price. And here, tucked in that, is the fundamental problem. Banks took a hit, took a whack. If we now go back to the Japan situation, a balance sheet problem, all sorts of problems there. Why did this particularly hit RBS? Well, because, of course, it expanded its balance sheet on the way in by the purchase of ABN AMRO, amongst others. So it was especially bloated as the hammer swept through. Now, as we look forwards, the sort of conventional theory of establishment central bank bailout is that they put money in, things turn around, it picks up, and then things that were put in suddenly look cheap. But this hasn't happened, has it? As I explained with the share price earlier. Why is that? Well, prospects looking ahead aren't really that good. Each year we get a lot of rhetoric from the bank directors and the board, but then things always disappoint. They're never really quite as they say. We're always a bit short, sometimes a long way short of what was hoped and the expectations that are set. And that is the problem. If we look round some of the other banks, we see a very similar pattern. Say something like HSBC, in some respects that should be surging ahead with its connections in the Far East. Obviously in the last couple of months, not so hot because of the issue of the trade wars in China. But it has just seen its chief executive officer go. If we look at the other bank in the UK that was nationalised, Lloyds, we see that its share price is approximately 50p now. It's been more or less that for quite a while. Again, very little progress. That's the problem of the credit crunch era. We've made the mistakes of the Japanese, and when we move to the real economy, the problem is that the banks can't finance it anymore, and we need a change. Thank you.